What's up, everybody? Thank you for joining the inaugural Messari Happy Hour Twitter Spaces. Before we start, I wanted to start with a quick disclaimer. All opinions expressed by our hosts and our guests are merely their own opinions. They do not reflect any endorsements or opinions of their companies. This discussion is meant for informational purposes only. You should not take their opinions as investment advice, as you will be solely responsible for your own investment. Hosts and guests may hold cryptocurrencies discussed in this Twitter Spaces. Additionally, certain Messari employees are required to disclose their holdings, which is uploaded monthly and available at our website. I've taken the liberty of sharing that up top, so you can go directly to that tweet and link. Without further ado, gentlemen, kick it off.
Hey, how's it going, everyone?
What's up?
Hey.
What's up?
Mike, Kunal, Tom, James.
Yeah, all good. You guys can hear me?
Yep, all set.
Yeah.
Tom, what you been thinking about?
Oh, Tom, we cannot hear you.
Is it me? We don't hear Tom, do we?
I think he might be having a technical difficulty.
Okay, I'll answer for him. Tom's been thinking about the merge, and Tom's been thinking about Optimism and all the roll-ups.
All the roll-ups.
All the roll-ups. Is it roll-up season? What are
All right, I think we can kick it off with the the Optimism airdrop, right?
Yeah.
So I think Tom had something to share about that, but how I've been thinking about it is that I think it's very hard to game the airdrop. So we saw that the criteria that they'd used was very specific and quite hard to game. I have been recommending on our calls that I think you have to be a legitimate user to get these airdrops, and making like hundreds of accounts is sort of I think negative EV. I don't know what you guys are thinking, but I think Arbitrum is going to use like a similar approach, in that not this exact approach, because I'm sure some people will try to do this like sort of weekly interactions with the protocol. But yeah, so what do you guys think?
I think probably the most effective mechanism was they had like a multiplier, right? So like
Mike, you're on mute too.
Wait, can you hear me?
No, I can hear him.
Oh, okay.
Oh,
Okay.
sorry. I'm
Yeah.
sorry.
they had like a multiplier. So like, if I'm not mistaken, you met one category and got X OP allocation. You met a second category, you got another OP allocation. But the fact that you met two was like a multiplier, and I think that adds like a more Sybil resistant like layer to the reward schema, because it's very easy to like Sybil farm some transactions on a thing, but not everybody's going to take the step to like Sybil farm Gitcoin grants or Sybil farm these kind of niche bridging behaviors and like certainly sized wallets. Like that level of complexity, like rewarding those multipliers, I think really biases the allocation more towards individuals, which was definitely like a very positive thing to see.
Yeah, I like that they reserved a lot of the airdrop for like future usage. I think like one common critique I have of airdrops a lot of times is that you're rewarding like past behavior when in reality you want to reward future behavior. And so I think what it was like 5% that they gave retroactively, which was I think a fine number. I think like it's like a combination of like instilling goodwill, but also not making sure you give up too much of what can be a powerful incentive mechanism moving forward. Does anyone think that 5% was too little or too much?
So sorry, can you guys hear me?
Hey, Tom.
You're good, Tom.
Sorry about that. Yeah, so I missed a little bit of the first part of the conversation, but I think 5% is an interesting number, right? I think the most important thing is they made sure that it wasn't gamed, right? There's a lot of ways to get it between transactions. You could have done being a repeat user, being a Gitcoin donor, whatever it was. But the key thing is they were aiming to make sure that there wasn't a lot of people who were able to game it. And they're sort of like future-proofing it by having another 14% that other folks actually try to get by interacting with the network by some unforeseen sort of things they might be doing. So I think it's interesting to see folks experiment with these new kind of airdrop mechanisms, right, and trying to incentivize behavior. I think the most interesting thing that these guys are doing or thinking about is they think this new model that they're laying out could be sort of a vision statement for all of crypto and airdrops kind of going forward. So what is that? It's like these two houses they've sort of built, and they call one the token house, one the citizen house, and it's essentially one is supposed to focus on short-term objectives, one's supposed to focus on more long-term objectives. And I guess the cynic in me says that sort of just sounds like shareholders and a board. But, I think in general, they think this sort of new model could align short-term stakeholders and longer-term stakeholders. So, what does that mean for the sort of token environment? As, I think the biggest question in my mind is like, I think this probably kicks off what a lot of us think could be like L2 token wars 2.0. And then sort of how do we think about positioning for kind of that environment. So I think this is the first in a good experimentation and something that we're going to see moving forward, a lot. So it is a kickoff sort of a broader.
I think there's lots of like tiered approaches nowadays to just governance in general, right? So kind of tagging off of your citizen versus token holder, that kind of split that they're running with the token. You see the same thing now with like the vote lock tokens. Like, so convex, you can stake convex and just get the economic rewards, or you can time lock convex and you get more like governance allocation of gauges rewards, but you have to commit for that time to the protocol. So I think like these more mature, it's kind of, I guess it's kind of cringe sometimes to move towards TradFi and stuff like that. But look, the shareholder versus board model is so prolific across companies because it's worked, because it's been a good way to balance the fact that different participants in a system have different incentives and goals. So taking a split view is kind of almost a like more mature way of doing things.
Yeah, I'm not against the like progressive decentralization. I think generally like that's what most projects optimize for, just because it makes sense to have some sort of coordination, especially at the beginning. And so like I think like that model has been like fairly adopted, and I don't necessarily see that changing. I think the most interesting part to me on the like the upcoming like quote unquote like L2 wars is where certain L2s decide to compete and go to market. Like, are they going to optimize for DeFi, optimize for NFTs, optimize for a different market? And so that's something that's like top of mind for myself.
Yeah, and I think in that, like, where does the value accrue, right? Is the value accrue to the L2 token, or is it like the fat protocol thesis, right? Like the L1 sort of wins out. It's tough to say right now. I think Optimism is going to have a nice head start because it's going to have a lot of mind share as it kind of goes forward. And if you start to look at, how other sort of L2 tokens have been in sort of market value, you're likely going to see a $1 billion plus total valuation, at least to start. So it's going to be sizable. And, I think others might be able to sort of chip into that as we move forward. But at the outset, Optimism is going to have all the mind share. So they're going to have the opportunity to really steer the ship here.
Yeah. I had like a valuation model, like a suggested valuation model maybe for Optimism already. So let me know what you guys think. So, we know that the revenue as Optimism sees it is going to be of the value generated of the sequencer. So essentially what MEV does the sequencer generate. And we can compare that with what Ethereum is doing right now, right? So if you go to flashpots.net, explore.flashpots.net, you can see that Ethereum did about like 2,000 ETH worth of MEV in the last 30 days. So that's like $6 million that MEV was generated on Ethereum. And 99% of that is on is on DEXs. So you scroll down a bit and you see Uniswap V3, Uniswap V2. Both of them are like more than 90% of the MEV generated, and Balancer and Bancor and such are like the remaining like 9 or so percent. So in my opinion, MEV is like, I mean, this DEX MEV is generated off of the depth of the liquidity pools, right? So if you have like 100 billion in liquidity, you will need that many more funds to move the X, Y, and K equation, and that's like sort of the MEV that you can generate. So if you just compare the TVL on Uniswap on Ethereum versus the TVL on Uniswap on Optimism, I think you can get a rough estimate of what the MEV can be on Optimism. And I mean, right now it's about 0.6%. So the uni TVL on Optimism is 44 million, and the uni TVL on ETH is 7 billion. So that's like about 0.5%. And if you put that with the MEV, so 0.5% of 6 million is about like, I mean, the calculation is about like 40K, and that's your monthly revenue on Optimism. So, I mean, you can put like a multiple to it, but Multicoin gave this valuation model where the value of the network is the present value of all future MEV, right? So if, let's say, ETH is doing, 200 times the MEV of Optimism, then the network should be valued at 200 times of Optimism. ETH is right now valued at about 350 billion. So Optimism is valued at about 2 billion, in my opinion. So, I mean, this is like a rough calculation. It doesn't assume any costs, because I think costs are sort of paid out in Optimism tokens. So the developing entity, the Uniswap labs of Optimism is being paid in Optimism tokens. I think transaction costs are paid for by the user. So there's all of it like sort of flows through, and there is no cost. So, and the revenue is the profit. So yeah, that's like my rough valuation model for Optimism.
Interesting. Do you think that like same model tracks to other L2s, or do you think it's like, does the model have to specifically change based on like if it's Arbitrum or immutable or a different L2?
I think that's a good question. If they have the same tokenomics as Optimism, right? So right now, I don't see anything on Optimism for like staking and like owning more of the network, which would add like supply and demand dynamics to it. But I mean, if they use the same tokenomics, I think that's how you value them. I think also this assumes that the valuation model given by Multicoin, which is the network should be valued at the present value of all future MEV. That's like, I mean, that it makes sense to me intuitively. I can go over it, but I think most people have like sort of, they know of it and why that makes sense. So, I mean, I think it makes some sense. And even if like, even if you don't want to adopt that model, if you just say that 40K is the current revenue, you can model some TVL growth on Uniswap, right? On Optimism, it'll be incentivized a bit more. With their future airdrops, people will like conduct more of their business on Optimism. I see it going to like up to like 10% of ETH too at some point. I mean, not like immediately, not in the next year, but sometime like 10% of ETH is I think a very, very achievable target, and then you get like essentially 10% of ETH as your market cap, and that would be like very, very that would be very, very big.
Yeah, I think one of the tricky things, and you kind of mentioned it there, is a value accrual, right? So they're getting all the value as revenue from the sequencer right now. And that revenue is then sort of disseminated by the mechanism of one of the houses here. And they actually, vote on where to disseminate it through the protocol. So, theoretically, that should all filter down back to the token. But there is a gating mechanism there to sort of say where that money goes. And, that could sort of change at any time. So that's just another variable to be aware of. And, if you assign a risk premium to that, great. But it's just another thing that's a little different about this one.
Yeah, that's absolutely right. So, I mean, great point. Of course, like, as an individual, you don't earn the future MEV. So you should apply like a bit of a discount to it. If the funds aren't being utilized well enough, you apply a larger discount to it. It's like, I mean, the idea is that theoretically, the money that's being pumped into the Optimism network to grow it will lead to, like the same amount of growth as at least the amount of capital put in. But yeah, absolutely, you can put like a bit of a discount to it because it's not your money. Like it's some like liquidity discount, 20%, or like if it's worth managed, then 40, 50, whatever you want.
Yeah, and just to
I'll go for it.
Yeah, just to give some perspective on some of the, TVL on other L2s, right? So Optimism's like 500,000 or so. Loop Ring is like 300 million. Their market cap on their tokens like $1 billion. Metis is like 150 million. Their market cap on their tokens a little higher than that, but about the same. Boba is like 50 million. Their market cap on their tokens like 175 million. So, trading sort of 3 to 5x, at least on those few. Immutable, 60 million on their TVL, 400 million on their market cap. So that's sort of the range, I think, depending on what the TVL kind of shakes out, which I think jives with what your initial rough estimate is as well.
Interesting on the you said Immutable was 60 million, because I think they over the past like 60 days they did like 70 million in NFT volume, and so like I think that's like an interesting disconnect. It could just be like how, or I imagine that stats from like DeFi Llama or something. So it could just be if it's like indexed differently. But that's interesting. And I think that like brings up like interesting points in terms of you have a lot of these L2s competing for the same market share. I imagine like Uniswap is a big portion of the TVL on both Arbitrum and Optimism.
Yeah, like I think, I think Immutable X's TVL can't be compared because it's like, it's not like sort of general purpose EVM, but like things like Metis, I think Arbitrum, Optimism should be. I think, in my opinion, I think one way that Arbitrum should now perhaps compete. I think we saw like Sushi put a lot of pressure on Uni, and I can expect like maybe the Arbitrum token coming out like fairly soon. I think an announcement from them would now be like, I would guess like within like a month or two. So it should be very, very interesting. What if if L2 wars now start? What sort of incentivization plans they give? Optimism hasn't made it very clear what like the future airdrops will look like if Arbitrum tries to buy more activity, buy more sort of TVL. Would be very interesting.
Yeah, I feel like it's a little different though, because like in the context, if you think of like Uniswap was kind of their hand was forced to issue a token just because it was like very much a vampire mining attack versus like I don't know that Optimism is like, sure they'll be competing on some protocols, but I think the strategies of incentivizing adoption are a little more targeted, and so like rather than just go after like retail capital incentivizing adoption, I think they'll probably offer grants and go a more specific approach, which like Arbitrum or any L2 could like theoretically do even before their token launched.
Yeah.
Yeah.
So hopefully,
just like, I think the valuation you get after the token launch will be, the amount of funds that you will have at your disposal post the token launch will be much more, I imagine, than before one. And if Optimism starts like an ecosystem grant like some of the other layer ones had, right, like Solana, Avalanche, Polygon, I think it could, it could take like the market lead off like L2s away from Arbitrum, and I think then we see something there.
What do
definitely.
You guys think about the actual long term? So short term, let the degens do what the degens want to do. But what do you guys think of the actual long term prospects here, right? Because at the base level, our Optimism token is being swapped for some Ethereum, so sequencers can commit the data of the rollups. to the L1, right? And then essentially it's a fee split, right? Which is how you're getting all these cheap fees, but you're anchoring in some sense like that relationship between the price of Optimism to the price of Ethereum at some, ratio depending on usage here. So, say it costs me $100 to commit my block as a roll up, and say I'm requesting $150 of Optimism token. So, Optimism protocol is essentially arbing $50 there. But the problem with arbitrage on things that are known how to do is people take those away, right? Like if somebody launches Optimism and they're charging a 50%, fee to commit cost premium, someone's going to come along and launch a 42%. And then someone's going to come along and launch the 30% to 20% until we're arbitraged to bare minimum. And then at that point, once you're running at such a small actual premium, you're essentially just, I imagine, trading at some essentially pseudo peg to ETH. So long term, do these tokens even make sense? Because then once you're pseudo pegged to ETH at just a small premium, you might as well just use ETH like you were originally. So do you think there's any long-term logic to actually having a token for the roll-ups? Like, it's fun. We all love exit liquidity, and a lot of people have invested money in this, but long-term, do the economics pan out?
Tom, thoughts? Or I can go.
I think it's pretty tough to see the economics panning out, especially with optimistic roll-ups personally. I think ZK maybe, but it's hard for me not to just see all the value accruing to the L1 eventually. I think there's others who would certainly disagree with me, but I don't. I see this as more of a short-term shaking out rather than a longer-term play.
I mean, the question on like the other side is like, what type of value are you providing? Whether it's in terms of security, whether in terms of liquidity, network effects, and does that demand some sort of premium? I think you can make an argument that it can, and it really just depends, because like the end state, like who knows how it plays out, but like I kind of imagine that you'll get certain applications that pool to certain chains, whether that's like a whole category, like lending, or like a whole sector like DeFi. And so I think that's kind of like where the interesting question lies, because if you have all this liquidity locked, say the whole DeFi ecosystem is on top of Arbitrum or Optimism for Ethereum, like, is that competitive enough in itself for that type of value extraction? I don't have an answer.
It'd be nice if we had all the answers here. We don't, unfortunately. Hopefully you guys got the Optimism airdrop. I was successfully gamed out of the system. I did a transaction on Optimism, and I think you needed to do 2 transactions. So they were successful in locking me out and only awarding actual users. So good on them. I'm gonna pivot here though, if you guys are good, to the merge.
Take it away.
Yes, I love it. So I think we have a tweet pinned up, Doug, but you guys are all familiar with the merge by now, I think. And the real tough part has obviously been the timeline. It's been, I think started back in 2017, when merged, 2019, and now we're in 2022. We're still not here. Something that's given me sort of more optimism, obviously we've launched sort of multiple sort of forks of different shadow nets to sort of test a lot of this stuff. But Justin Drake, who I think you guys are pretty familiar with, he's a researcher at the Ethereum Foundation. He has a pricing model for ETH, sort of a yield model. In the proof of stake world, what would you yield in sort of an optimistic and sort of a conservative scenario? And he tries to time the merge in that model. And this model has been around for quite some time, and I'm sure many of you have tracked it. And his model used to have a huge swath of months of when the merge could actually potentially occur. It was something like June to December. And the Ethereum Foundation researchers met in Amsterdam last week. And right after that meeting, Justin Drake updated his model to just make the merge actually occur in his model only from August 1st to August 31st. So I don't know if I'm reading too much into that, but it seems like an interesting time and to actually update that in a very specific period. So I guess I'd first of all love to get your feedback on that. Maybe I'll start with Mike, and then what are your thoughts on how to think about the merge and potentially how to think about it as an investment opportunity?
Yeah. So as far as merge timing, I'm just gonna put my hands up and say it'll happen when it happens. I've seen enough people get that one wrong to not want to hop into that pit. But as far as
I'm with Mike on that.
yeah, exactly. As far as how it changes Ethereum, basically, I think like I'll make an analogy that I think is pretty consensus at this point, but it really sets a risk-free rate in the ecosystem, right? So, historically in the past, we're all buying and selling and trading and having fun and yield farming and all of that stuff, but you're kind of untethered, right? You're essentially just creating whatever speculative model you want, or you're looking at CoinGecko and saying, well, this is rank 50 and this is way cooler. So when it passes, all those silly websites are like, what is X at X market cap, basically. But I think now once you have successful operation proof of stake Ethereum and you have Ethereum yield denominated in Ethereum, you've officially set the bar. So if Ethereum's giving me 7%, I'm just making up numbers here, but if Ethereum's giving me 7% and, not picking on any protocols here, but why deposit at Compound for less than 7? Why deposit at like Alpha Homora for less than 7, right? You've officially raised that bar of performance on the network. So, I think a lot of projects and protocols are in for a little bit of a surprise when all of a sudden you can get close to double-digit yields on what I think is an asset that most people are just natively pretty bullish on. So it in my mental model, it causes a pretty sharp repricing of a vast majority of assets. And, maybe if a protocol's revenue is tied to ETH, they're a little more isolated from that. But if a protocol's revenue is tied to a lot more of these tokens, maybe you're a little less isolated to that comparative devaluation.
I love it. Although, I think Mike 100% agree, but I think, Tom, would you say that this is now the risk-free rate for like the Ethereum ecosystem? I don't know about the crypto ecosystem, but definitely the Ethereum ecosystem. And then I think it may put negative price pressure on everything on ETH. So whether it's NFTs or like DeFi tokens, if I can get like 7% native yield on ETH, do I really need to be flipping francs? I don't think it. I don't know if that's like
you always have to flip francs.
You might want to disclose francs,
Actually, I'll hop in here real
so
fast with one. Just sorry to cut you off. I'll throw one curveball or one wrench in the thing. Everybody kind of has consensus that if the 10-year yield went up to like 20% or something crazy, it'd cause a lot of havoc. Is there such thing as ETH yield being too attractive, where staking yield is too high and you're making too much money off of MEV, that now all of a sudden these other protocols can't siphon off any ETH, can't siphon off any investors, can't siphon any revenue, and you actually hurt the ecosystem because the yield is too attractive? Is that a possibility?
Yeah, I think that's a great point. What do we call it? The anchor problem right now? I think there is a level where it's too high. What that level is, I'm not sure, but there has to be some risk premium assigned to ETH up and above treasuries, up and above, equities, because there is a legit risk, whether it be small or high or however you want to assign it. There's a risk that ETH goes away, or that there's some, unforeseen hack, even though it hasn't happened in almost 8 years now. But I do think the longer it's around, once we pass that sort of technical event risk, I think it becomes the sort of risk-free rate for the industry, because it has that, 8 to 12% yield. And I think it really just becomes like legit catnip for investors, right? Like, what do investors want? They want a yield. Like, what do they want? They want, environmentally friendly sort of securities. Okay, great. ETH is 99% more, environmentally friendly. It has a underlying, potentially net deflationary currency. Like, it's just like the confluence of narratives, I think, around ETH and around the merge. Like, once it actually happens, the drum beats are just going to be so large, and the inflows will be, so strong that I think there'll be enough money in the ecosystem to filter out to the other, sort of protocols and participants that, sort of liquidity won't be an issue because there'll be enough new inflows, and then, the rate won't be so punitively high that it'll sort of, detract from actual value in those other protocols. But I'd be interested to hear what Mason thinks on that one.
I mean, I agree with a lot of the points you guys are making. I think one like unique aspect is that, like, if you consider like yields you can get on ETH right now, think about how most people are going to stake that, like, either are institutions or if they're like more enthusiast investors, like there's some take rate that all those middlemen are going to provide. Like if you go stake ETH or Atom or any asset that you can stake on Coinbase, they have some type of take rate, and it's actually like fairly significant. And so I wonder if like the yield will be significant for those who are able to do it natively, but there's still going to be some sort of like ARB opportunity, so that for your, call it like average investor, it ends up being significantly less.
So I want to come in here and talk about Lido. So it is a significant holding for me, but I think it sits in a pretty good spot on the decentralization curve, right? So it's not Coinbase where it's like very centralized, and it's not Rocket Pool or like individual validators where they won't be able to capture the capture MEV, right? So I think Lido sits like somewhere in the middle. It takes like 10%, which I think is a fair rate. I mean, Mason, you would say on Atom you take about like 5 to 10% on average on like the different validators.
Yeah. So I'm staking Atom on both Kepler and Coinbase, and I think it's like 11% on Kepler and a like 4 or 5% on Coinbase. So that's like, they're taking 50% of your yield, which is like pretty significant.
Yeah, exactly. So I mean, Lido takes like a flat 10%, and 5% goes to the treasury, which accrues essentially value to the Lido holder. So I had a piece on it recently out last week, and I mean, I think the case for it becomes like stronger as we move towards the merge. Tom, you were asking how to play the merge. I think Lido is like one of the key beneficiaries of it right now. I think about like 10 billion or like somewhere around that is what is staked on Ethereum, and we can expect this to be much higher going forward, right? So on most of the other networks that are purely POS, like Polkadot, Solana, Cardano, all of these, they're all above like 50%. I think Terra is one which around 40%. So if you take like with 50% ETH being staked and Lido maintaining its like market share, there'll be like, so the 350 billion worth of ETH, 175 billion is staked, and 30% market share for Lido gives it like 30 billion or something. So yeah, somewhere around like 20 to 30 billion. That's going to be like 2 to 3xing its current market cap, and I think that's like very, very. I mean, it's a big trigger in my opinion. I don't know if it's like priced in. I don't think it is. I mean, my valuation model says that it isn't, and even on like a conservative side, I think there is upside. So that's just like my take. I think it's a good way to play the merge, and it doesn't suffer the same sort of, Mike brought up this point, whether your yields are denominated in ETH or like are more sort of on the long tail assets, and Lido has like direct yields on ETH.
Yeah, I mean, I think Lido has a place in terms of having like a more decentralized staking provider. But at the end of the day, like sometimes it just comes down to owning the user, and like Coinbase, Kraken, like any exchange is going to have obviously that user base, especially once they like compound a lot of these other features they have. And so like I'm not convinced that most individuals will go to another option just because it provides a better yield. I think you'll get a certain portion that do, and any like enthusiast who is like fairly even like non-technical will probably be able to stake with Lido or Rocket Pool or some other solution. But my intuition is that users usually sacrifice capital and time for convenience.
I mean, that's fair. I don't think I disagree, but I think we saw A16Z, buy like Steth essentially. I mean, I don't even know how big their Lido position is, but I think they bought Steth through Fireblocks. So I think you can expect like institutional guys to come in and use these liquid derivatives instead of going through like a trusted solution like Coinbase or Binance. And I think on the legal side, you should be like fine too if you're doing it through Fireblocks, whereas it may be more difficult than maybe like custody risk if you're doing it through Coinbase and Binance and such. So I think, I think that both sides. I mean, of course, users are lazy, and we haven't really seen like them necessarily adopt like transacting on chain, but with like OpenC2, that if it like makes sense, they will.
Yeah. So I think institutions in particular are gonna try to do it through something like a Fireblocks and a little more sophisticated, right? And they're gonna want to hedge the currency exposure, because if you're locking in an ETH yield, you don't want to have that volatility. If you're thinking it's sort of going to be somewhat of a balance in your portfolio and you want to just capture that yield rather than play the price risk, you're going to need an intermediary to actually sort of like price out options for you to do that. So you're going to need a third party to kind of price it in. Other thing I'd say on sort of how to play the merge, and all the options are really thinly traded, especially for US investors. So it's really hard, but just like looking at some of the major options markets out there and observing what the pricing trends are, the merge right now, say it happens before the end of the year, options markets are pricing in only a 20% possibility of ETH hitting a new all-time high this year. So, I think we talk a lot about the merge, like everyone knows it's going to happen at least some point in this year, and that it's so potentially bullish, but it doesn't seem like it's still priced in. So there's somewhat of an opportunity, whether you think it's going to happen or not. I think there's a lot of ways to play it out there still.
Rest in peace, stock to flow, but it always had. It takes some time. Like I know there's lots of debates like, can you price in true changes to supply and issuance dynamics, and who knows what it looks like. But typically if stock to flow was still kind of accurate, it'd be you have the happening and then it takes some time for this to actually generate any response. So say merge happens end of year, say stock to flow kind of lagged response mindset takes 6 months after that, you can be and I don't even know what the options depth looks like that far out, or if you can even, I know like Lira, you can only buy options on like a monthly basis. DopeX, you can, I'm talking about like decentralized methods of like looking at options and this kind of stuff. Like it's pretty weak offerings, to be honest. Like they're all still just monthly. Like no one's giving you long dated multi-year call options on this kind of stuff. So it's kind of difficult. I can see why the option prices aren't reflecting like a nice reality there.
Yeah, I mean, crypto markets aren't known to be very efficient. So, I mean, Tom, to your point, when you brought up the upgrade in Justin Drake's model on Polymarket, right now there's still like a 50-50 for it to happen by October 1. So, I mean, you can if someone's so inclined and they can predict when the merge is going to happen.
What is the depth like on Polymarket? Polymarket, for those who don't know, is a predictions market.
Yeah, so it's 150K, Mason, which is not low in my opinion.
How much back to the Lido thing? How much design space do you guys think there is in the kind of like staking derivatives game, right? So like on the most basic level, you're just offering some tokenized receipt of a deposit in an ETH validator, but then you can go beyond, like say Lido hits this crazy run rate, they're printing all this ETH through their stake yield. I, as like a Lido user, I would expect them to spend a lot of their revenue on developing MEV software, and then I'd expect them to like share that MEV software with their validator. So then Lido has the best yield in the game because they're running more advanced MEV software, and then Coinbase and Kraken, and then everybody does that. And then now I'm like, okay, well, you have to spend your money on like integrations. Like if you're a Lido and I'm using staked ETH or something, I want to be able to use it in lots of places. So you should issue some of your revenue as rewards to Alchemix. So then Alchemix integrates you, and then issue free token rewards to Compound. So Compound lists you. And then all of a sudden, these competitive pressures, because the design space is, I think, actually more open than a lot of people think. Again, it just kind of crushes, or not crushes is a strong word, but it definitely compresses the super high margins that you might think these protocols actually get to run.
I think a counterpoint to that would be that Lido actually needs to have relationships with validators. So it's not like easily forkable in the sense that, Yearn Finance was, and you just copy the code. So I think there can be some some defensibility there. Also, how pervasive it is across the DeFi ecosystem. I think it takes time. So even Reth right now, the Rocket Pool's Reth, even that's not available everywhere, right? Like Steth is way more accepted. So I think those two things provided some defensibility against against competition. Pretty much. So I don't think you have to. So they don't need to pay Alchemix to integrate their. It already does. It's the largest. Steth is already the largest. Aave already does it. I don't know if Compound does it, but so they're large enough for them to not have to pay. They're like Walmart, and they can squeeze. So my opinion is that they will squeeze they can squeeze validators out later. So but right now they're paying 5% to the validators, but if they hold like significant amount of staked ETH, then all validators must go to Lido for for their share of their staked ETH, and in that case, I think Lido has the ability to squeeze the validators. Why pay them 5% when you can get away with like 4%, 3%, whatever cost basis they have? Add whatever cost plus 10%, cost plus 20%, and manage their margins like Walmart does.
That's interesting. Yeah, I mean, it's almost kind of like, Lido will essentially try and vertically integrate down the Ethereum infrastructure stack. I think that there's other interesting solutions that will be required for, horizontal type of infrastructure. So for whether it's layer 2 tokens, whether it's other tokens that have some sort of lock period that act as a work token as well. So I think that Lido probably won't compete on every single protocol, and that they're definitely probably going to double down on ETH.
Yeah. Okay. So I'll have to hate on my own calls. So Lido's considering a proposal. Lido's considering a proposal where it gives Steth holders, so staked Ether holders, veto power over some proposals. I think it's very interesting in the sense that it makes sense that
what's an example of a proposal?
Yeah, so let's say increasing fee to 80%, right? I mean, it's just hypothetical, but let's say there is a proposal like that says that, I acquire enough Lido because I'm like a giga whale, and I'll say that let's just push fees up to 80%, and whoever is too lazy to pull out a Steth will keep paying me, keep paying me their sort of staked yields. So in that case, it's proposing to give Steth holders the ultimate veto for some proposal decisions. And I think it really takes away from the governance premium of Lido. So, we've talked about the cash flows that Lido will get, but one thing that the governance here, the zero value governance aspect of it gives, the value comes from the Steth holders wanting to secure their rights. So if I have $1 billion in Steth staked through Lido, I have some incentive to own the protocol, right? I don't want Lido holders to take away more of my staking yield. So I have some incentive to buy Lido, and that's I think the case for tokens that don't get cash flows like Uni. So if I have like a significant amount of like uni LP tokens, I have like an incentive to hold some uni tokens so that they don't take away like a lot of my transaction fee, right? The LP fee that I'm getting. So I think giving this power to steth holders takes away all of like the governance power that Lido has, and I think negatively affects like, yeah, I mean, I will say value. Negatively affects value for sure.
Yeah, I mean, it's a centralization risk, right? And if nothing else, I mean, Lido's something like what, 30% of ETH deposits right now, which is the biggest, really significant. So I think there is, at least if you care about the centralization. I mean, we should care about sort of moving away from Lido, but it seems they have the best network effects right now, so that seems fairly unlikely to happen. You guys are gonna. I kind of want to pivot to stablecoins. So we've had sort of stablecoin wars, which we talked about L2 wars before. We've had sort of the Terra ecosystem. Huge yields on Anchor, 20% plus. We had the recent launch of or upcoming launch of the Near token that looks like it's going to be 10%. I think it was supposed to be even higher. Justin Sun from Tron, I think he said something like 30% yield over there. So I'd be interested to hear what you guys think about this sort of stablecoin war that's coming out, and sort of who the winners, losers, or otherwise will be.
I mean, I think that like that's an interesting question. I don't know that there's going to be like one winner or loser in like a specific regard. I think like USDC has obviously done phenomenally well to date in terms of its like adoption. I'm curious. I think DAI has done like fairly well, given that it's been like bootstrapped based on like ETH as a collateral, and obviously like USDC is a big portion of that collateral nowadays, which is like an interesting point as well. I think like you can look at it from the perspective of like what do consumers want, and that's going to be like the easiest stablecoin to interact with. So I think like the individual like exchanges, wallet providers will have like a potential position in like if someone wants to use a stablecoin, what stablecoin are they using? In regards to like other stablecoins, I don't really have like strong opinions yet on how that plays out. Mike, do you have any opinions, or Kunal?
Yeah, I think stable coins, I think it probably has like one large stablecoin project on each protocol, and perhaps UST connecting all of them through like the through all the bridges. So I think it's unlikely right now. I mean, I was quite worried about USN and the Justin Sun stablecoin coming out, because I thought a lot of capital may move out of the mercenary capital in crypto, may move away from UST, which would put pressure on like the price of Luna. But I think right now it doesn't seem like that's happening. Near said that I think they're going to give like 10% and not 20%, which I don't see why anyone goes there rather than just like keep farming UST on Anchor. So I don't see how they're going to bootstrap their liquidity or like start their pool when there is like a proven 20% available on Anchor. Like, many billions already there, fairly safe as it goes in crypto. I mean, I think it's like UST is definitely the king to take down.
Yeah, I think this is just to chime in on stable coins. I think from a really high level overview, those protocols that can pivot to those more basically provide that non-volatile risk for those that are looking to transact. Those protocols are going to unlock so much more, less fear for those institutional investors and those that aren't as familiar with the space to kind of move liquidity around. But I mean, yeah, from Luna standpoint too, it'll be interesting to see basically how farming on Anchor during a bear period, what's going to prevent the the outflow of UST from the protocol when you do move into a bear market. And I know Do-Kwan's Do-Kwan LFG booting up 4pool, where essentially in efforts to dry up DAI as he stated after, but
the key is liquidity, right? So like you just hit on it, like whoever can get the most liquidity is going to win. So, and how do you do that? You spend on marketing, and all of these yields in my mind are just a marketing expense at the moment. So if your marketing expense is like 20%, you better hope you are able to attract enough users with that 20% to hit sort of a exit velocity before, you sort of implode at some point, right? And I think that's why I was sort of surprised to see at least Near's token come out at 10%, because I don't know who wins in that. It's not attractive enough for users to come over. Sorry, go ahead.
Oh, are you still there?
Can you hear me?
Yeah.
Yeah, I was surprised to see Near's like 10%, because who wins in that? Like, who actually wants to come over for that yield when you can get that almost anywhere else in sort of DeFi, even farming sort of much safer stable coins. 20% seemed to be a point that folks are willing to jump over. So and if 30% actually comes out from Tron, I think we're all going to be a little surprised. So I think it's really just all about liquidity, right? And who can sort of win with those marketing budgets to get the most liquidity.
I think it's a little bit more than like just a marketing budget too, though, right? Because the way you receive the yield on these is through deposits. So you're pulling, for fear of having the lunatics come at me here, UST has this beautifully large supply, but how much of it is actually exposed to peg risk because you've deposited all of it in Anchor, essentially, right? So, yes, I agree with the like theme that it is a marketing expense, but also more than that, it's how you take UST off the market. So you only need to defend the peg against a smaller swap volume, right? So as far as like, have we seen an algo stablecoin work? I don't, I'm all for the VC transfer mechanism. If, not to call it, if Galaxy Digital wants to keep giving away money to everybody and Justin wants to start giving away money to people, hell yeah, let's go for it. But, you haven't seen an algo stable. I don't know if we're counting like Frax or Fei, they're much smaller supply. They kind of have, maybe something going on there. But of the like Near coin, of UST, of all these things, you haven't seen an algo stable work in reality, in my opinion. So I'm all for the like, take the VC money here. Like don't complain. Like they'll defend the peg, but I don't think any of these are like live products. I'm not impressed.
Dustin, any thoughts?
I'm trying to deduce what the question is, but if it's our algo stables successful, then I think you got to break it up in two phases, right? You got the first phase is essentially the growth stage. I need to get a bunch of supply out there. The second stage is figuring out, can it be productive? And that's where you can say, is this successful or not successful? It's really kind of unfair, in my opinion, to judge kind of like in the supply expansion phase, is it successful or not? It doesn't really make any sense, right? So like you take the Luna model, it's a totally different model than DAI. DAI is like, we're going to be safe step by step. Luna saying, screw it. I'm going to get as much supply as I possibly can, and then we'll figure out how to be, productive afterwards. So that's like, to me, that's kind of a good approach, because like from a stable perspective, you really do win the ball game if you get a lot of supply.
Do you count the supply if it just ends up in Anchor, right? Like I can mint 30 billion of a stablecoin, lock 29,999 million in a smart contract, and then I only need to defend the peg on one stablecoin outstanding. Then all of a sudden, like, would you say I have the most successful stablecoin project in the world? Because I'll code it up tonight, right? Like it's not.
Mike, can I get in on
that?
that?
Doesn't count. Does it count is my question.
I mean, if the end state is 80% of the supply is in Anchor, then that's probably not successful, right? But I don't think that's what anyone probably envisions the end state to be in a successful scenario, right? The way I see it is like you're going to want a bunch of supply, whether it's in Anchor or whatever. Initially, that's fine. But the second phase of the game is really, all right, now what do I do? Where does it go next, right? Does it go into Astroport? Does it go into other chains like Avalanche? Does it go into, they made these partnerships with Synapse, right? So do you start to see it get used more in like the L2 wars, or what you want to call it? That's really what you got to start judging next is, how effective is it coming out of Anchor? I think the peg risk thing is kind of overblown in my opinion. Like we're not going to just flip a switch and we're going to see $1 billion flip out of Anchor. I think people kind of know what we're doing here to some degree.
You also have the locking mechanism, right? To what is it, 3 weeks or something?
For Anchor, yeah.
So I have a bit of a tinfoil on Anchor and Terra Luna, right? So I think if you buy $1 worth of UST, I think they make more money than they pay out in a year. So they pay out about 20% in a year, but I think they hold enough of the supply that the math of it works out in their favor. That if you buy one UST and even if you lock it on Anchor, even if you get the 20%, at the end of the day, the team that's backing it, whether it's like TFL, LFG, whatever, all of them combined, they make enough money off of that $1. And using that, and they understand that, and using that, they've grown it enough for it to have, in my opinion, escape velocity. I think there is, in my opinion, very little peg risk now. They have enough funds backing it, like 10 billion or something like that, right? So 2-3 billion worth of Bitcoin plus additionally like more funds. So I think very unlikely that the peg breaks. I think the only thing that can happen is some bigger boy comes with like a larger balance sheet and gives 25% or 30% on their stablecoin. And I thought Near may have been that protocol, or maybe Justin Sun, maybe that maybe that billionaire who's willing to do it. Other than that, I don't see how UST now loses its dominance. It's become so big, right? They've sunk their teeth into everything.
The answer to that is regulatory, though, right? Like there's regulatory risk, amongst all stable coins. And so, if you take it from the counter perspective of USDC and Circle and Coinbase, they've obviously taken a very conservative approach. And if we get to this end state where, say, the U.S. government has to adopt some sort of U.S. pegged stablecoin, and they praise God, don't end up making their own, then what are they going to pick? Whether it's white labeling a bunch of them or picking ones that are already established that they consider to be the most regulatory compliant. So I think that's really the if you talk about the not bear case per se, but potential roadblock for UST.
I do think degen disclaimer here, but one of the interesting things about UST essentially is as soon as they started acquiring Bitcoin as a reserve asset, I think it actually fundamentally changed changed the prospects of the network. So from a purely protocols that exist standpoint, there's nothing on Terra that we haven't seen anywhere else, right? There's not a huge innovation happening there. I think the real innovation happening here is you can now run the Sailor strat, whereas Sailor has to go use the revenue and balance sheet of his company to go to the market to acquire X dollars at X rate to buy X amount of Bitcoin. Terra can print the dollars and just kind of make the dollars out of thin air and buy Bitcoin and put it on the balance sheet. And then, it's a little bit of a gamble here, but if Bitcoin pulls some multiple, all of a sudden your partially reserved stablecoin is now over collateralized. So you can issue even more to buy more Bitcoin to even get to a peg, right? So I think if you want to play a kind of levered degen gamble on just Bitcoin through a protocol that can print its own dollars, that becomes kind of interesting. So I would like to see Near do this, but with ETH, and then someone do this, but with Solana, and all of the sudden it gets a lot more interesting.
It's kind of like a reverse rug pull, right? Like if you were like the US government and you started, hey, USD is backed by gold, and then, oh wait, it's only backed by a little bit of gold, and then, oh wait, it's not backed by any gold, right? And I think that's what Frax is doing. Like, hey, it's completely back. Okay, now it's 85% backed, and now it's, they're tearing it down. It's almost like Terra's doing it the reverse. They're saying it's backed by nothing. Oh wait, okay, we'll add some BTC. Oh, we'll add some Avalanche, and sort of filling that up as maybe these prices appreciate. So I think that's interesting. I could probably something to that.
I know we're coming up on time. Any last thoughts on any of the topics we discussed before we call it a day? Cool. All right. Well, everyone, thank you for coming to the inaugural Messari Happy Hour. We're looking to do these every couple of weeks, and so go ahead and hit that follow button on the Messari account to get notified for when the next one comes up. And thank you all for joining.
Special shout out to the talent as well. Thank you guys. Send these gentlemen a follow. Keep tabs on articles that they drop, so on and so forth. 4 to 5 p.m. Eastern on Wednesdays, like Mason said. We'll be doing them bi-weekly to start. And if things go well, you might see us every week. Thanks, everybody.
See you, everyone.
See you. Thank you, guys.
See you guys. Thank you.